I use mathematics to pass my funded prop firm challenge. For every successful trader and a successful prop firm trader in a sense, risk management is a critical aspect for successful trading. Whether you are a seasoned professional or just starting out, understanding risk and reward is essential. Risk management, it isn't just about avoiding losses, it's also about optimizing the performance so that even when losses occur, they don't jeopardize our ability to trade in the future. That's the most important thing. You can trade in the future no matter what happens. Many of the funded prop firms you see now are actually banking on the fact that a lot of the traders are not aware of how to control their risk management, and because of that, they lose their challenge and subsequently the fees. Well, where do you think the multi-million dollars of revenue that the prop firm have come from? It came from this. In order to understand how I control my risk, it's actually very important to journal and back test, because you need data to do all this. You need data to identify what is your strategy. You need the data to identify all the parameters in it. That way, I know that with my strategy, how much is my ideal risk to reward, how much is my winning percentage, and with that, I can use mathematics to apply and calculate how much I should risk per trade in order to pass the challenge. Especially in prop firm challenges, the risk to reward ratio is critical. It's like balancing a tightrope. You need enough risk for the reward, but not too much such that you lose the entire challenge. The most important thing to the secret of passing prop firm challenges is risk management, reward, and probabilities. You just need to know these three to successfully pass your challenge. It's not about making money, it's about staying in the game. Surviving in the prop firm challenges is key, right? Key. In order to succeed in the prop firm challenges, you need to understand the concept of risk of ruin, right? It refers to the probability that a trader will lose their entire trading capital due to a series of consecutive losing trades. In the context of prop firm challenges, this concept is especially important since it means you are blowing your account. You might see this chart somewhere. I actually just took it off the internet, but the message is especially the same. For this area, you are practically losing money. This area, you are breaking even, and in this green area over here, you are profitable. Yep. So with that said, you need to match your win reward with your risk reward over here. Even though you are actually trading, like let's say in this Bullion Notes 50K account, it's saying that you are trading with a 50K account, but you actually don't have the entire 50K at your disposal. Instead, your drawdown represents your entire trading capital. In this case, this Bullion Notes 50K account, your drawdown is 2,500 and your profit target is 3,000. So the goal here is to meet the profit target of 3,000 without hitting the drawdown of 2,500. Consider the other rules as well. Prop firm has a minimum trading days, and also you can't instantly pass within a day. You will also have free reset by the end of the month. So make use of this in formatting your own trading plan. And if I want to pass in the earliest time possible, but after the minimum trading days and without blowing my account, this is how I structure my plan. This is my little spreadsheet calculator. Consider the usual risk to reward ratio for your strategy. How frequently does the strategy occur within a month? Does it appear every day? Will you trade every day? Is it a scalping type strategy where you trade multiple times within a day? Like once you have this information, you can determine the probability of success and the risk reward ratio that you want to apply. For me, this is my own personal trading style. I tend to be a one trade a day trader, and even if my probability of winning is not that high, my risk of reward is much higher, and 6.7 is my own personal sweet spot. And once you have all this, you apply it against a binomial distribution. So how it works is it's a bell curve where this is the average distribution of probabilities. And in this case, the probability out of 12 attempts, because I typically have one trade a day, and in 1 month, that's maybe 20 trading days, minus off some days where I'm not trading, like the high impact news of FOMC, etc. Then I have only maybe 12 trades in a month. And then how I apply that is that for these 12 attempts, what is the probability of me winning just 0 attempts? For all of this, the probability is 1.38%. What about the chances of me winning just one attempt, one time out of these 12 attempts? It's 7.12%. And what are the chances of me losing the money in that particular month? So I calculated the expected value of me losing, how much money I will lose if I lose every single trade, and maybe just losing 11 trades over here. And over here is like winning 0 trade and this winning 1 trade. So the chances of me losing in the month is if I lose um, 1 trade, or I didn't win any trade at all. That's this two over here. And the probability of that is 8.5%. Is 8.5% an acceptable risk for me? For me, then yes, it's actually quite conservative. And especially if you see the statistics of how many people failing off the prop firm challenges. Okay. This approach will let me make an informed decision whether my current trading strategy is worth it or not. If, like, let's say I would like to increase my probability of winning from 0.3 to 0.4, but at the same time my risk to reward ratio might be down to 4. Then it's up to me, like, let's say I would just uh, adjust over here to see like whether it is worth it. 0.4, maybe 4. I am adjusting the value, see, like whether this is something I am comfortable with. The probability is still roughly the same, but my reward is changed. So it depends on your own personal preferences. For me, 200 is a bit on the risky side, but it's still a sweet spot for me. But this is just for the end of day trailing drawdown for accounts like Binomial option 2. What about those intraday trailing drawdown for accounts like Binomial option 1 or Apex? So with the same perimeter of 30% win rate, I actually am using a different approach such that I considered um, that I lost the first trade completely. This is because like how I'm doing it is that I am assuming that I have lost the first trade completely, so that any moving intraday drawdown, it doesn't affect my calculations anymore. Okay, yeah. So it's like this. I'm assuming I lost this entire like $800, such that the whole um, chart, it will went up to almost target, like barely meeting the target, and then just completely draw down. And that to me is how I remove the impact of intraday trailing on my expected net value calculation. And if you see this, the probability of losing is actually higher. Even though, like, let's say I will go back over here, I'll change it back to 0.3 and 6.7. You will see that even though a probability of just winning one, cumulative winning one for end of day is 8.5%, but for the intraday, the probability of me uh, winning just one trade is 4.7%. So the chances of more losses is actually higher over here. And because of this, I tend to reduce my risk in order when I'm trading intraday trail down. So how I usually do this is, like, let's say in Replicanto, there is the ratio methodology. I will use my end of day trailing to be the fixed standard, and then I apply 0.6 so that it will auto calculate the position sizing for me. In that, for, like, let's say if I'm trailing an FX account, each time I am risking 200s for a trade in the Binomial option 2, in the same FX, I am using a smaller risk to minimize the impact and also reduce the risk, reduce the chances of me losing. But even though you see that um, the net impact is also the net dollars I'll gain is actually also at the lower end. So why do I mention about like all these risks? Because um, when you are trading, you will need to determine like how much are you risking per trade, and how you are doing that is by determining where is your stop loss relative to your entry. Let's say your entry is over here, and you are entering along, so that's why you are looking at the stop loss. The stop loss will be somewhere around here, and this area between your entry and your stop loss is your risk, and this is how much you are giving it like a buffer for the chart or the trade to move on. And how you determine that is like depending on the instrument you are trading. Contracts like ES has $50 per point, whereas MES is 10 times smaller, it's $5 per point. NQ has $20 per point, while MNQ is smaller at $2 per point. And in each point, it can be split into 4 ticks. So you see that the option there's actually not as much split compared to CFD, where CFD are much smaller in size. You can trade a lot smaller in CFD relative to ES, MES, NQ, or MNQ. But because I focus on futures account, so I am trading strictly the futures instrument instead of any CFD. And how am I doing that in platform? Here, I will show you. Okay. This is a Tradingview chart. Let's say if you're trading off the Tradingview, there is a long or short position tool, which I had it as a shortcut over here, and this is the MES contract. I can create this, and like let's say I'm risking like this. This over here is showing the risk to reward, and this is saying I should trade 17 contracts to meet the $200 risk reward. And how I know this is that I have initially said that I'm risking $200 per trade. So each time I created one of these, it is always risking $200, which is this red area over here. And if I want to turn it into actual trading, I just need to right click and create limit order. You see that I am risking $191 in this particular trade. That is how I know like how much contract I should trade to risk $200 in this particular trade. This 17 contracts, 17 contracts. The stop loss is below, and it's also closing at 17 contracts as well. And let's move on to another platform. This is my Ninjatrader chart. So how you can determine is you draw a risk to reward, such as this one. This is the risk to reward tool. Okay. Yeah, you see it for Ninjatrader, the risk to reward tool, which you can actually test by going here, the risk to reward. Like once you draw it, you'll see that it's actually like saying you are risking like $15, $16 in this particular area. This is just for one contract. If you want to go and determine how much is it, you should trade contracts at let's say 20 over here. I want to trade 200. So it's just 200 divided by 20. So I should trade 10 contracts each time. That's how I am determining like how much I should risk per trade. Or second, where how I'm using. This is for me a paid indicator because I use this as a ease of life indicator where I just need to determine my stop loss, my entry, and my exit. It will automatically set everything for me. Well, this is a live account. Answer it first. Okay. Yep. That particular indicator is set to $200 risk. So that whatever trading position I open with that tool, it automatically set $200 for me, including the contract. That is how I determine my position sizing to pass my to pass my futures problem challenge. All right, thank you very much, and see you next time.